Hi, today we're looking at a statement of profit and loss account question and a statement of financial position. And in this question, you're going to be given a trial balance, which is here. And all of this is a trial balance. And it has a number of adjustments, which are underneath, which are here. And you have to then, I think, here it is the requirement. Normally it's at the bottom, but here's at the top. Prepare a statement of profit and loss and a statement of financial position as at 31st of December 2016. So the first thing to do is, I suppose, I'm going to run down through these and look at what's expenses, income, and where they go. So we'll assume, that someone coming at this doesn't have a lot of knowledge of the accounts. So here I've just gone down through the trial balance and just noted a couple of things. So inventory, this is your opening inventory, and that always increases the purchases because to this year's purchases we need to add any inventory that we've carried forward because we're going to sell them this year. Sales returns just reduces sales. Purchase returns reduces purchases. And they'll all appear in cost of sales. So our starting point always in the statement of profit and loss is sales. We reduce it for sales returns, which I've said in the trial balance, and then you take away your purchases or your cost of sales. So there's our purchases, less purchase returns, plus opening inventory. So you list the figures down. There's an adjustment to purchases I'll come to, less closing inventory. If there was carriage in, it would go here as well. Or if you were told some depreciation expense needed to be added to cost of sales, it would go here. But otherwise, this is your cost of sales, and you take it away from your net sales to get gross profit. And I'm just going to go down through the rest of the trial balance now. So wages and salaries, an expense, commission received as other income, and that gets added straight under gross profit. These three are expenses. Go in your expenses in the statement of profit and loss. Provision for bad debts just reduces receivables in current assets, non-current assets. And it'll be cost minus accumulated depreciation. So at the end of 2015, our fittings were only worth 32,000, and now we've to reduce them again for 2016. Receivables and payables, current asset, liabilities. Bad debts is an expense. It's always an expense. There's equity, and these two are current assets. So then we have to adjust for a number of things. Here's closing inventory, so that is going to be an adjustment, as are all of these. And note F here is the adjustment for purchases. So included in purchases is a figure which should have gone into shop fittings, so we reduce purchases by 1,000 and increase shop fittings, and that's why purchases is only 249,000 here. There's closing inventory, and then we've added commission received, so that's the cost of sales figure there, gross profit, commission received, and now we're on to our expenses. So you just go less expenses and you list all the expenses down and find your net profit. But before we do that, we're going to work down through it. So the first adjustment is closing inventory, and that reduces purchases and cost of sales, and I've shown you that, and then it goes in our current assets. The next adjustment is telephone, and this is a current liability, so CL is a current liability. That gets shown in statement of financial position. And we also increase the expense by 200, so we come up to our telephone expense. Here it is here. And now that's going to be 2,200 in our expenses. So in our expenses here is the telephone, and it'll be 2,200. And I'll get to all the other expenses in time. And in the statement of financial position, which is part B to the question, if you were doing it, your current liability is telephone, and you show 200 there for the telephone. As in our current assets, our closing inventory of 95,000 gets shown in current assets. So I'm just going to move back and forth between it as we go. Note C says included in rent is a sum of 2,000 paid for a premises, covers the period from April 16 to March 17. So our year end, well, is December 16. If we've paid rent up as far as March 2017, that's we've prepaid for 3 months. But what you do with a prepayment amount is you show a current asset and we reduce the expense. So here we have to work out what the rent prepaid is, and then we will reduce the asset here of 15,000 by whatever the repayment is, and we'll show a current asset for the amount prepaid. So when we look at to work it out, it's paid up as far as March, 17 March next year, which is 3 months. The period is 12 months if you count from 1st of April to 31st of March. That's a 12-month period: April, May, June, July, August, September, October, November, December, January, February, March. And I'm counting on my fingers. That's 12 months. So 3 months of that 12-month period, so 3 twelfths by 2,000 gives €500. I think it's just missing that there. And that's the repayment amount. So we'd show a current asset of 500 and reduce the expense by 500. Which means we come up to rent and we just show 14,500 as an expense. So here in our expenses, rent is 15,000 minus 500, and you can show the worker or not. This working isn't that important. Just hide it. That's the 14,500 adjusted expense. And then in your current assets, we've got rent prepaid of 500, and that's the next adjustment is part D. Receivables includes a certain bad debt of 100. So we reduce receivables by 100 and increase bad debts by 100. So this is part D. I just don't have enough room to do it here. So that's pretty simple. So come up to receivables. It goes down by 100 and bad debts increases by 100. So in our expenses, we'll show 1,100 for bad debts. And our bad debts here, 1,100. The next adjustment is E, the provision for bad debts, 8% of receivables. So our receivables now are 9,900. And we know that the provision for bad debts, which we looked at up here, all that does is reduce receivables. So the new provision is 8% by 9,900, 792. So in our current assets, we're going to show receivables less provision for bad debt. So current assets, receivables 9,900 less 8% works out. So the receivables then really are 9,108. And so what we're doing there is saying at the end of the year, our customers owe us 9,900. Of that, we think 8% or €792 are not going to pay us. So this 9,108 is a more realistic or a more prudent figure. It's a more, cautious figure. We're not overestimating the amount we're going to get ultimately. There's another aspect to the provision. So we've already looked at the current asset. What happens? We just show the reduced receivable amount. When we look at the provision itself, it was 900, now it's 792. It's reduced from 900 to 792. It's reduced by 108. If the provision reduces, the easiest thing to do is we need to show an expense. And if the provision reduces, show a minus expense of 108. If the provision had increased, we just put in a normal expense. But here it's reduced. It's like income coming in. Previously we thought 900 weren't going to pay us. Now we've reduced that figure down. So it's good for the company. So it ends up reducing your expenses. So anytime there's a movement in a provision, the movement bit is going to hit your expenses. If it increases the provision, it'll go in as a normal expense and will increase your expenses. If it's a reduction in provision, it just reduces your expenses. So in our expenses, we're going to have 108. So here it is, reduction by debt provision, 108. Here we have note F, included in purchases, a figure of 1,000, which should have been included in shop fittings. So we just reduce purchases and increase fittings. So reduce purchases by 1,000, so purchases is going to be 249,000. And fittings, so it's important you increase the cost. So not the cumulative depreciation, so 40 plus 1. And our shop fittings now will be 41,000 cost. So that brings us on to note G, shop fittings depreciated by 10% using reducing balance. So when it's reducing balance, you multiply the percentage by the cost minus accumulated depreciation. So we find the cost up here, it's 41,000. Then the old depreciation for previous years, or prior years, were 8,000. Where is 8,000? So 41 minus 8 is 33,000, and then multiply that by 10%. we'll get an expense of 3,300. So in our expenses, we show 3,300. And that's where it goes in here, depreciation and shop fittings, 3,300. And you could show the working there for it. I think I have it hidden actually here. So we know our expense is 3,300 and we've put that in expenses. Now the non-current assets section needs to be updated. So when we look at our shop fittings here, it cost 41,000. The cumulative depreciation up as far as last year was 8, but now it's going to increase by this year's expense of 3,300. So our cumulative depreciation is going to be 8 plus 3, 11,300. So, and that's going to reduce the cost. And in our non-current assets, really, we've 3 headings. Shop fittings cost 41, cumulative depreciation 11,3, and it ends up as 29,700. And that's what it looks like there. So then all we do, I think that's everything done. There's our statement of profit and loss. Sales less cost of sales gives gross profit. We add other income, which is commission received, take away expenses, and we get a net profit of that. Statement of financial position, you add in the non-current assets. We had only 1. Then we add in the current assets, and we looked at their adjustments already for this. The other current assets were bank cash, here's the bank and cash, 2, 5 and 1, so you just pick them from the trial balance. Current closing inventory is another is a current asset, and anything prepaid, rent prepaid of 500, which we already worked out. So that's where those figures came from. Add your 2 assets together, your non-current and your current, to get total assets. And then we've 2 other headings, well, 3, equity and liabilities. And so our equity is always these 3 things: capital plus profit. Capital plus profit less drawings. We get these 2 amounts from the trial balance. Here are capital and drawings. 76.5 minus 12. And then our profit comes from the net profit figure, part A. And that just gets carried down to here. And the last thing is our current liabilities, and we find payables and the accruals. And here are our payables, 7,200, current liability. And the accruals are anything due, so telephone due at the end of, or accrued at the end of the year, 2,000, anything that's owing that hasn't been paid at the end of the year. They get out together, and then you just go equity plus liabilities, gives you total equity and liabilities. If we had a long-term loan, we'd have non-current liabilities and long-term loan there, and that would get added in as well. But we don't, and you know you're right, then when the total equity and liabilities equals the total assets. That's it. I hope that was useful. And we'll see you in class, and enjoy the break.